All right. Good morning, everybody. So the number one thing this morning is that bonds seem to have found a little bit of a bottom and began to rally late in the day yesterday, which carried over into the overnight hours, and they're continuing to move up this morning. So while stocks are still down, bonds are actually up. This is um, a change of the guard. It's a change of what has been going on, and we're going to dig deeper into it. But just recognize that the short trade with the 10-year rising, the dollar rising, U.S. dollar, Japan rising, short ES. That's been the game most of the week. That ended yesterday. We had the 10-year pullback with the dollar and the U.S. dollar, Japan, and we still saw the ES go down with it. So instead of an inverse correlation, we actually started to develop a positive correlation. And then instead of having a positive correlation with stocks and bonds both falling, we have the bond rising and stocks falling. When I say stocks, quote, stocks versus bonds, it's just a generic way of saying the ES, the S&P, the NYSE and the NASDAQ, and quote, stock versus bonds. So there is a change, and we've been looking for a capitulation, right? The change from Tina, right? Yesterday, there is no alternative, just take the short. The change from that to that last hurrah. If we were going up, we would call this a blow off top. When we're going down, it's a capitulation low, right? It's when everybody's finally convinced that we're going to go down, and they start puking out of all of their positions. They just dump their portfolio, and they finally get on the bandwagon to go short, which is usually where we flip it over and run it back up again. So if you've been watching for the capitulation low and the last hurrah, I think we're there. It still needs to play out a little bit, but we've seen this before. The only thing that's throwing a little bit of a wrench into things is that it's Friday. But some of the Bank of Japan interventions happened on a Friday, just like this. They started around 10 o'clock, 9 or 10 in the morning, and they were done by noon. So, history, what's the old phrase? History doesn't repeat, but it sure does rhyme. Something like that, right? So looking at what's going on around the world, Hong Kong is down the worst. I didn't get to dig too deep into it, but I believe Evergrande did file for bankruptcy. If I'm wrong on that, there was some filing, some news this morning on Evergrande that was actually official, not just a rumor anymore. So if it wasn't bankruptcy, then it was something else. It was filed, not just a rumor. And that has a little bit to do with what's going on with Hong Kong being down the most. Japan also down nearly 1%, and then getting into our markets where we're down marginally, right? This isn't down very much. The NASDAQ is down the most, more than 0.75%. Then we have the Russell, then the S&P, and then the Dow Jones. It's not that bad. Just a second. Okay. Anyways, so yeah, it's not that bad. All right. For today, we don't really have too much on the docket for, economic events. The Eurozone CPI data was the biggest thing, and we already saw the results of that. The PBOC, China, had ordered their state banks to continue buying. That's pretty much the only stimulus we've really seen. And you know, they're doing it so often now that it kind of loses its power or its gusto. How many times can they continue to go in there and order the banks to buy stock? You know, it's oh, it just kind of loses its mojo after a little bit. So you can see we're about ready to wrap up the week, and we don't have too much left at this point. Even looking ahead to what's coming in on Sunday and into Monday, you know, other than the additional auctions next week, we really don't have anything. Kind of adds to what I'm saying. If we're looking for that last hurrah, we might just finally be getting there. So you can see today, we really don't have anything. By noon, I would say you're probably good to go, but really, even this industrial production price index doesn't have a historical impact, right? It's not generally something that would cause a volatility, and it's for Canada, right? So it's not even US production. We can see the volume this morning is coming in nice and strong. I say that, but you know, if we were looking for like that big wow volume from yesterday, I mentioned the same thing. We talked about that. It's just not here, right? We don't have that big wow volume because this isn't fear. It's not, it's just a nice, clean, controlled sell off. We do have a market maker move this morning, and that holds a lot of weight, right? Earlier in the week, we had economic events that could have moved the market, and we still didn't have a market maker move on those days. Today, we have no economic schedule, and we have a market maker move. They are running into the front end of the curve. They're trading into the front of those options. This isn't speculation, right? We're not guessing that they're doing that. We know that they're doing that, or there wouldn't be a market maker move. Kind of goes to my argument that this might be the flip event. So the volume, while it is elevated a little bit, I think we're pretty comfortable with understanding where that volume came from. And even though we don't have any economic data on deck, the slightly elevated volume we've seen there is still within normal range. What you would want to do if you came in and you've seen the volume that high, you'd want to go and at least understand why, right? We know because we just went and looked at it and we talked about what's going on. But if you hadn't had that background yet and you've seen the volume up that high this morning, you'd want to go look, right? Remember, the whole reason I do these briefings is to kind of teach you how to do your own so that you can tailor them to your own specific needs and purpose, right? So you can see the ADR here. It's the yellow lines and the red lines. The yellow line being this one up here, 44.27 and 43.30. That's the full ADR from where we closed last night to a single direction ADR. The ADR stands for average daily range. It's a 21-day average, and a market month is 20 days. So we look back over 1 month of data and ask, from its highest point to its lowest point, how far has the ES traveled on average on a day-to-day basis? And that answer is around 1.1% per day, which is about 48 points. So we just use that to kind of ask, well, if today is just like any of the other days, what's the move that it should make or that it should stay within? And that would be the yellow line from where we opened at Globex to the upside or to the downside. That's what we call the full ADR. And then there's the ADR half. The reason we need both of those numbers is if the average move is $50, I'm just going to round 48 up to 50. If the average move is $50, then we could move $25 higher, $25 lower, and we would have a $50 range here. That makes sense. But what if we open and just run $50 in one direction? Or we open and we fall $50 in one direction? So we need all four of those lines. And that gives us the context that we're looking for. Right now, we're nearing the edge of the ADR half, 43.55. We have an MDP, missed daily pivot. We don't have one from yesterday. We actually tangled up into it a little bit near the open. But so far today, we do have one. We're inside day breakout. And while we closed near the low of yesterday, we continued that move this morning. So it's not like we rallied up and then broke down and fell lower. Looking at the weekly chart, we're getting closer to the 20-week moving average. And I believe that is simple, but we're going to swap it over to an exponential just to, I like the exponential better. We want to put that number on our intraday chart here, 43.53. Now we could just draw the line. That's fine, right? There's nothing wrong with that. But we do have the indicators that will draw the line for us. And I say, why not do it that way? Right? Let technology do its job. So we want the 20 period weekly. And of course, for me, the 20 is green. You do you, whatever color your 20 period is. Just make sure that I know it's a weekly. All right. So now we've got that plotted down here. If we can get through the ADR half, then we'll contend with that 20 period weekly moving average. $10-day, 30-minute volume profile. When we're at the high, we expect to go to the lows. When we're at the lows, we expect to go to the highs. We're at the lows, we're making lows. Throughout the day today, it won't matter how far we go through the day. We're going to continue to have the same shape of this profile, but we will lose that peak. 45.60 will no longer be the high after, say, the end of the day today, or as we get closer to 3 o'clock, we'll lose that high, right? Because every new candle we print on the right side will take away a candle from the left side. And by the end of the day today, that will no longer be our highest point because it'll be gone. The new high at that point will be 45.45 unless we run up there. Now that might seem like I'm reaching a little bit, but I'm not. We can easily run back up there today. We're going to get to previous examples of what it looks like when we flip the script and run, but it is absolutely possible that we run all the way up there today. Just remember that half the trading day is already done. And I know that that is usually something newer traders struggle to understand, but the trading day started last night at 6 o'clock and we're past 6 o'clock now. So when I say half the trading day is done, literally, I mean it. We don't have much time left in the day before the day is over. We can see the VPOC from yesterday did a really, this is the line I said I would remove later. I wanted to see how price interacted with it in the intraday if we happened to come back to it. And yesterday we did, right? We did come back to it. We interacted with it and I don't need it now. I can go ahead and take it off. but it demonstrates the age-old question, or at least the answer to the question that I get all the time. How soon do you take that line off on the VPOC? Do you take it off immediately, or do you leave it there for a little bit? Um, if it got hit in the Globex, I leave it on there for the rest of the day because it might not be done yet, right? But it's definitely done now. We cut it and crushed through it, so we don't need that one anymore. 43.55 is another VPOC area. So we have an anticipation of price reacting around that level, and then below that 43.50, which is a gamma level. It's a structural level. It's got all kind of connotations and weight behind it. But 43.55 would be the next one of concern. All right, so this gets us into the weekly expected move. We have this week's weekly expected move, and we've already got projections of next week's expected move. Now, at this point, it's only a projection. These lines are active, they're moving, and they'll continue to move until the end of the day, at which point they'll lock into place. And after that happens, they shouldn't move again. So the first thing I like to do, even though they're not set in stone yet, is I like to compare them with the current week. I draw a box, just, I don't even get all down into the weeds trying to make that box perfect. Just snap a box, get it kind of close, and then overlay it on the new week and see, is there more volatility or less volatility? If there's more volatility, the box will be bigger. That's simple enough. The market makers are pricing in more volatility for next week. What's on the economic agenda next week that would cause them to price in more volatility? Nothing really that big, right? We got a few things on the dock for next week, but nothing big enough to account for that kind of volatility. Okay, so it's not that. I mean, that like, okay, well, what else we got? Not much. So this is just pure trading volumes that are doing that. And we know the volumes have been light, but even light volumes can target certain strikes or certain expirations and move the volume readings or the volatility readings, excuse me. So we can just take note of it, right? It doesn't really change anything in the grand scheme of things. We just recognize that the volatility is wider for next week and that it's not set in stone yet. But there's another line on here today worth talking about, and it's this cyan colored line. I don't discuss it much because most of the time there's not too much to discuss, but this cyan colored line is an anchored VWAP, and it's anchored from the start of the year through most of the year, or at least since, the end of March into April, we've been holding above that anchored VWAP. 42.33.5 is where that anchored VWAP resides. And we are at a critical pivotal level, not just in the ES, but in a lot of the Magnificent Seven, the Great Fangs, your large mega cap markets. Some very critical markets are at this key structural level, and it needs to hold, or things could get a little out of control. I'm not saying that the S&P is going to go back to 3,900. But we could certainly get a flash crash and get down to 42, even 41.5, before they get things under control. I was watching Tom Bosley yesterday. He presents at stockcharts.com quite a bit. Tom Bosley, yeah, I think it's Bowley. And he had something to say about the pace of the move that I found to be very interesting, and it provided insight worth considering. The S&P in 2 months moved more than 10%. More than 10%, right? In 2 months. And yet its historical average is 10% for the whole year, right? And that historical average going back like 70 years, its average yearly move is about 10%. So the S&P moved a whole year's worth of movement in 2 months. You have to anticipate a pretty good sized pullback after that. And since it moved so fast, it actually moved the 50-day with it. And then now, since the 50-day ripped higher so strongly and so fast, and we're pulling back, we broke that 50. Well, generally, we'd look at a break of the 50 as a significantly bearish signal, because in the last 70 years, moving 10% a year, we don't generally break the 50 unless things are getting ugly and nasty. So this break of the 50 can't be seen as the normal break of the 50 that we would use. And I hadn't thought of it that way until he brought it up. You can certainly check stock charts and hear it from him. I'm sure he's going to do a better job of talking about it than I just did. But it does feed into the narrative that I've continued to carry, that this is just a pullback and that we're not headed back down to the lows, and that in fact we're still looking for the stick save where they come in and play save a hoe and flip this market back around. So let's get to that point of the discussion, because I want to talk about what it would look like, some of the things that we want to see if this is going to be the flip day like we had back in October of last year, when the Bank of Japan coordinated with Swiss banks and US banks, and they all came in and ran this magnificent intervention and flipped the market over. It was a heck of a Friday where we just ran like a mad dog demon. And it wasn't the only time where we had such a flip, but here is one of those, and it doesn't have the gap, right? It's not like we gapped down and then we rallied. It's not like that at all. We opened, went down, things changed, we turned around, we ran all the way back up, and we closed at the highest point of the day. I mean, there's a little bit of wick up there, but we closed in the upper, say 25% of that candle. That's what's on the docket today, right? I don't want to make you believe that this is going to happen. I don't know for sure, right? Nobody knows for sure, but we've got a lot of the key ingredients that we need for this to happen today. One of them being that push in the bonds that started yesterday. Now, all they have to do is stop buying those bonds and start buying stocks. They don't have to dump bonds. They just have to redirect that fire hose of money into a new direction. This was a double bottom, and it needed to go lower than the previous low to trap bears and convince those bears that we were actually finally going down, right? That's what a good double bottom does, is it traps those bears. It needs to be just convincing enough that they finally take the bait. It was a key level, 3,700. It was a key pattern. It's like a micro double bottom setup. So everything that we would need, right? What do we have this morning? A wider double bottom, but still a double bottom. It needs to be enough to be convincing. So we got to go lower than that previous low. We didn't gap down hard, right? We opened and just continued to fall lower. We've got a key gamma level at 45.30, or excuse me, 43.50. Kind of turned those numbers around this morning. We've got US dollar Japan continuing to move to the downside. We've got the 10-year continuing to move to the downside. And sure, I mean, the dollar turned around a little bit, but that can happen for a lot of reasons that aren't directly connected to what we've got going on, right? So sometimes these things all run in concert. We'll have all three of these doing the exact same thing. And then there's some times where one steps out the door and goes and does its own thing for a little bit. We don't always know the why behind it, but I always argue you don't exactly need to know the why as long as you can recognize the event, right? That it is doing something different. And then you just set that data aside. So while I'm setting the data in the dollar aside for the moment, I wouldn't recommend that you ignore it. Recognize that it is doing something different, but don't let it influence your perspective on US dollar Japan and on the 10-year. And then we've got this move in bonds, which so far, sure, I mean, it's topping out a little bit, but that's kind of what we want, right? They need to transfer that flow of money from pushing bonds higher to start pushing stocks higher. And again, they don't need to dump bonds. They just need to quit pushing them. So that's what we want to see in this thing. We want to see this slow down, stop making big moves, and that is a really big move. And just kind of hold the line, hold the level. The only thing it really needs to do is not fall lower than yesterday's low, right? And that's not asking for too much. It would also be good if it keeps at least 50% of the move that it already has here. Right, so like a half back measure. Just take the highest point here down to the lowest point, look at the 50% mark. We could ask that it doesn't fall below that 119 level, right? And as long as it maintains that going into the weekend, okay, well, I mean, you know, that's about as much as we could ask for. If we can keep all of that and the 10-year doesn't begin to rally back up and US dollar Japan doesn't begin to rally back up, we have the setup for the S&P. The thing is, with this significant drop in US dollar Japan and that big drop in the 10-year, where's the reciprocating rally in the ES and the NASDAQ, which is what I started yelling yesterday afternoon. Hey, watch out, something's wrong here, right? We started to get that really big sell-off and there was no move higher. In fact, stocks sold off at the same time. So our inverse correlation broke yesterday. And that was the end of that entire show. So now we've got to regroup, be patient, and look for things to get back into their normal rhythm again. We're starting to base in the ES and the NASDAQ. We got what I call a failed flag play. It hasn't failed yet, but this is primed for exactly how I liked it to be. It can be a flag, it can be a pennant. Measure it from the lowest point back to where the break started. You can just use the last drop, right? So from VWAP down that leg, we got a 786 structure here, this little base. That's the flag that we're measuring. Now, a typical flag would break to the downside here and continue to go lower. And the next target would be 43.54. But if this isn't a typical flag, then we're going to break through the top here. We'll get our half back, get back to VWAP, and we'll just start working our way back up through all of those levels. It very likely won't be a straight shot. So, you know, you get a breakout, you get the Busby, you get the 50%, get the pullback, right? You get the idea. Price, we don't want price to move in a straight line. So we're primed, we're ready, we're there. And that pretty much lays it all out on the futures side of things. But what about day trading in all the good sweet stuff? Well, for one, everything has a 0-day today that has weekly options. So Apple, Amazon, Microsoft, Tesla, they're all 0-day plays today. You get to say that once a week, right? So Apple has continued to move very much like the S&P and the NASDAQ, but Microsoft has not. So we don't even need to talk Apple. You already know the play here. It would be the same play as if you were doing the S&P and the NASDAQ. Microsoft, on the other hand, it looks the same, but I would argue that it isn't. That yesterday, for an example, was completely different than what had been going on everywhere else, right? We had that, it held and held and held until the very last moment yesterday, into the later part of the day before it finally broke down. There is an old saying, maybe not so old, that if they're not willing to hold Apple or they're not willing to hold Microsoft, why would they be willing to hold anything else, right? They are the darlings of Wall Street. You can't get better than those two. So this kind of fits into the narrative for that capitulation discussion, right? That they're finally just puking out everything that they've got and they're just throwing their hands up and saying, that's it, I can't take it anymore. Now, I don't normally discuss the alpha protocol, but some days it's worth bringing up. The idea behind it is, if you've ever kind of dug into the way algos trade the basket, there's algorithms that will monitor the S&P 100, and it'll look at all 100 names in that basket. And if news comes out, the algorithm will trade all 100 names to adjust what is happening in the S&P. It sounds like a lot, but it's not, right? It's just a machine. You just GIGO. You put garbage in, you get garbage out. You tell it what to do, it responds. The thing is, when you get one of those rip rally days or rip dump days, like yesterday was a dump day, everything goes in that direction, right? It's a highly correlated market state. 99 out of 100 names all going up or all going down. That really strong, highly correlated market structure is what you want to target when you're running a protocol program. Now, your list can be comprised of whatever it is that you want, right? It's not for me to tell you what should be in your watch list. Plus, I don't know what you can afford, right? But if we were to just make a generic list with Apple, Microsoft, Amazon, Tesla, Netflix, right? Kind of go down and say all of the FANG names. On a day like this, where the expectation is a highly correlated positive market state where we just rip to the upside, you wouldn't go in picking and choosing which market to trade. You would just trade them all. You would buy calls in all of it. Whichever one doesn't move, you know, if 99 out of 100 names are going to all go in one direction, that means there's going to be a standout name, right? 1 out of 100. Well, you can reduce that 1 out of 10. If your watch list has 10 names in it, there's very likely going to be one turd that doesn't play and doesn't float well with others, right? So if you did buy all 10, one of them is going to be a dud. You want to try to recognize which one is the dud as soon as possible, kill that trade and let the others run. Running the alpha protocol is not something you want to do every day, right? It's not something you want to do every week. Usually you get 1 or 2 opportunities in a quarter to run the program. Depending on your broker, you very likely have an advanced decline line of some sort. on Thinkorswim, we've got a little more dialed in advanced decline line. You go to the Visualize tab, and then you choose Index, and you pick your index. So for us, we could choose, say, the NASDAQ 100 or the S&P 100. We'll pick the NASDAQ. We can see how many issues are advancing and how many issues are declining. Issues are companies. And then we can see where the money is going, which is important when we're looking for divergence between the amount of money going out than in versus the amount of issues going up versus down. So to decide if today is a highly correlated market state where you might want to run your alpha protocol, all you want to do is just come into the advanced decline and see how many issues are going up versus down. The reason I like this is because normally if you go look at an AD line and advancing versus declining issues, that is a formula. And the name tells you what the formula is. It's taking advancing issues and subtracting declining issues from it, and then it gives you a number. Now, I understand why they do that, but it just makes everything confusing. It's 100 names. Just tell me how many names are going up and how many names are going down, and I'll figure out the rest. But that's not what they do. They take advance minus decline, and then they spit out a number, and that's the number they give you. That's your advance versus decline number. This, you can see exactly how many names are going up and how many are going down. For a good protocol day, you want 98 or 99 names all moving in the same direction. Okay. The pickier you are, the more strict you are with this rule, the less you will get faked out. So, hold true to that 99 number. And if we don't have 99 names moving in one direction, you probably don't want to run that protocol program. Which options to buy, what expiration to use, you want all of that developed beforehand in advance so that you're not trying to figure that out on the day that you want to run it, that you've already worked all of that out ahead of time. Just keep in mind that when you trade in the money options, you're basically trading a stock synthetic, and that when you're trading out of the money options, you're basically trading the all the optionality stuff, your extrinsic stuff. So you're going to be expecting volatility or price to drive in the right direction to monetize those options. That's the only thing you're going to get. So you're going to need a really big move, or you're going to need them to, pump volatility in there. Since you're the buyer, you don't want them to strip volatility out. And that's the major threat for today. So on a day like this, when we are looking for a rip your face off rally day, trading out of the money options on a day like this isn't advised for your short duration day trades. They're going to strip the volatility out of those calls, and they're just going to lose so much premium. But if you trade the options that are in the money, there's not much extrinsic premium in there for them to strip out, right? It's not to say that it won't happen. It'll just happen less. So you want to trade the ones that are in the money on a day like this. Or if you don't want to do that and you do trade out of the money, trade a spread. I know spreads aren't glamorous and sexy for day trading, but it'll shunt or negate that volatility crush to some degree. To put it in a way that makes sense, here's the implied volatility of the options 7 days out in Amazon. If I was going to do an out of the money trade and I bought 3120 implied volatility, and then I sold 3102 implied volatility, then I got a 0.18 vol exposure, which is minor, right? It's a very small exposure. That's all they could strip away from me is 0.18. Anything else that they do, shenanigan wise, would only normalize those two numbers until they're basically equal. Higher or lower wouldn't matter because I've bought one and I've sold one. And so it's going to neutralize that threat to me. They can strip it all they want. One side is going to take care of me versus the other side. So if you don't want to buy the in the money options on the rally up, then for goodness sakes, put it into a spread. And if you're thinking, well, and the spread doesn't have to be out of the money either. You can do them right at the money. Say you buy that one and you sell that one, which is, I mean, that's a pretty wide vol spread, but either way, it'll normalize after they strip out what's there, right? About 0.4. If you're looking at this and you're saying, yeah, but there's only 32 cents of profit here. And I mean, that's a horrible number, by the way. We wouldn't want this. We're just going to continue with it anyways. If you don't like that answer, get more of them, right? Don't buy one, buy 10. Don't buy 10, buy 50. On Tasty Trades, the cap for your commissions is a 10 lot. So whether I trade 10 of these or 100 of those, I'm only paying commissions on 10, which is fantastic on a day like this when we really want to size up, right? These prices aren't even remotely accurate because things have been moving around in the after hours and the options chain doesn't reflect accurate prices until we get back into the open. So, either way. Now we can look at the watch list like this and we can see what's up and we can see what's down, but I'm going to argue that basically everything is down and that it's a part of the flip that we're looking for. So it really won't do us much good to come in here and see what's up and to see what's down. In fact, it's nearly misleading at that point, right? It's not going to be helpful. Now, I wouldn't recommend that we just run out there and buy a bunch of stuff without at least having some form of a signal or a pattern or something that says go long now, right? Otherwise, you're just trading on hope, and that's not a good strategy, right? Hope is real. Hope is not a strategy. So a few things that we could look at to determine when to activate the trigger and at least start buying. Maybe not the protocol, right? We already discussed what you need to see that. Everything all moving in the same direction at a 99% capacity. But price-wise, what could we look for as a signal to actually just go long today? Once we open, there will be a line in the sand. Okay, so that would be a good start. This is yesterday's close because I'm on a daily chart on Thinkorswim, and daily charts don't reflect real values until we get into the open. So this morning we're sitting at 434 in SPY, and we're still seeing the close 436.29. If you're looking for a trigger to go long, getting back above 436.29 would be a good start. Now that's not going to guarantee that, that it's going to work. Just saying that would at least be a good start. And it's a honest, true, defined trigger that works in a lot of trading strategies. It's getting higher than the previous day's close. Another signal that you could use if you, don't want to get faked out, use 50% of the previous day's bar, right? Especially that big spread out bar like we had yesterday. So that's a halfback play. The concern would be if we're in this downtrend and we're getting a little bit of a pullback before continuing the downtrend, that the pullback would stop somewhere around 50%, that halfback. Well, if that's your concern and we get above that 50% level, the idea that it is still a halfback diminishes a lot. It doesn't mean, guaranteed at that point, because nothing's guaranteed, but it's much less likely to be a halfback because we went too far. Just like this day, when we opened and price rallied and it couldn't get through that 50% mark and it fell back down. Cool. So that's what we're going to be looking for. Either one of those would be a good trigger that we rally up into yesterday's close and get above it, that we rally above 50% of yesterday and get above it, or even that we break entirely outside of yesterday's high and continue to get above it, because that's on the table too. I know I threw a lot at you guys for a Friday, huh? Yeah, sorry about that. You like it. So there is the other alternative, right? What if we just continue to go down? Well, the week is almost over. And we could use, some generic calculations like measuring last week's range, last week's candle, and projecting that number to the downside. We've got 50% and then we've got 100%. That doesn't really help too much, right? Because we're already past that 50%. So it was worth looking at, it was worth measuring, but really nothing there. Otherwise, you want to just play like we did yesterday. I've had a lot of people say it's hard to get into this. It is, but it isn't. It's just which kind of trader do you want to be, or how fast are you at the game? So without running a dynamic fib where you're constantly readjusting your measurement, which is what I do, you don't necessarily have to do that. You can wait for a pullback to begin. And when that begins to happen, we'll just back the chart up to that point, right? You're looking for a chance to get in. You've got a little micro double bottom here. So you had a reason to expect that we were going to get a short-term pause. We pause with the doji candle. We start to go up. Measure the last big candle. So now you've got your 50% mark. If this is going to roll over, it's going to happen here, right? Now, where you pull the trigger and where does your stop go? You want to pull the trigger after we get back below this 50% mark if you're looking for a continuation, but that is going to make you risk more money because your stop goes up here. So you can wait for it to break 50 and then get in. You can wait for it to close below 50 and then get in, or you can get in while it's still going up. And if you're using options, that's what's going to give you the better price. So when that green bar was still going up and it broke 50%, that's when you would be buying your put. When it's still driving up, that put is going to have its best price right there. The problem with that is that there's nothing here that's telling you that we're going to continue to go down, other than the belief that this isn't done yet. You don't have a short signal here. It hasn't broken that 50% to go back down. It's pulled back. It looks bullish, but that's why you'd get such a good price on that put. So it comes down to, what kind of trader are you? Do you need the confirmation signal that we're going to continue to go lower? You'll have to put more money on the line to do that, but you won't lose as often. Or do you take the trade that just offers you the better opportunity, dollar-wise and risk-wise? In that case, you would buy the put while it's still driving higher here. If none of those fit you, or you weren't fast enough to get there, then you needed to break the last big candle's low. And that's your entry, whether it breaks below or it closes below. If you're using a price pattern, you need the candle to close. Otherwise, the pattern isn't valid, right? That should make sense. So you can trade the pullback or you can trade the breakdown. Either way, you got to get in there with the expectation that it's going to continue to go lower. But it's easy to look back and talk about all of this, right? These candles are closed. They're not moving around. So I get it. But that's where, knowing your system comes into play. Either way, trading a trend like this or a move like this and trying to find reasons to stay in or to not get shook out, that you don't get scared of every little pullback, you can change the way that the chart looks to help you stay in. You can use the Renko chart or something like the Heiken Ashi chart. Just remember, if you're a price action trader, Heiken Ashi candles are not price action. So you can't read these as dojis and, pen bars and 2-bar plays and things like that, hammers and such. This isn't real price action. It's not. It's an indicator. I know it might look like a candle as price, but it's not. So the way you do use this is if you're already in the trade and you don't want shook out, swap it over to Heiken Ashi, and as long as it stays the color of the direction of your trade, you stay in it. If it does give you a swap candle where we were red here and we got a green one green, no problem. 2 greens is a warning, 3 greens, GTFO, right? Just cut that trade and get out. Now that's not perfect. You can see back here where we had 4 greens and then it did turn around and continue to go to the downside. Or 3 here and then it did continue to go to the downside. But we can see that that first 3 warned that the big first move was done, right? And if you were short from up here in that down move, those 3 told you to get out. And I would argue that was a good thing to do and that you could find a place to get in again later. You don't want to leave your charts on Heiken Ashi, right? This is just to help you stay in, to maybe help you avoid getting shook out and stopped out or getting scared and bailing out of a good trade. Renko would be the same thing, but Renko can get a little complicated because you have to go in and tell it what size of a Renko bar you want. So, but it'll do the same thing. You just stay in it as long as the color continues to be the red or the green that you're looking for. All right, everybody, be careful, be safe, have a good weekend, and I will see you all next week.